What if I told you that the single most powerful invention in the history of capitalism wasn't a steam engine, a stock market, or even a computer? Could a simple notebook hold the secret to unimaginable wealth? For centuries, merchants traded goods, lent money, and financed empires without truly knowing if they were rich or bankrupt. Ships vanished at sea, fortunes disappeared overnight, and debts could spiral out of control without anyone noticing. Then, something radical happened in quiet rooms. Across medieval Italy, something that changed the way humans understand money forever. But what was it? How could a simple method of writing numbers hold the power to control kingdoms, sway emperors, and reshape the world? And why did some families rise to power while others fell into ruin? The answers aren't in the palaces or battlefields. They were hidden in ledgers, notebooks, and counting houses. What did these merchants discover? And how did it secretly give them the power to change history? The most powerful invention in the history of capitalism wasn't the steam engine. It wasn't the stock market. It wasn't even the computer. It was a notebook. For most of human history, merchants didn't know how much money they had. Wealth was tracked through memory, scattered notes, and instinct. And for centuries, this worked, until trade exploded across continents. Suddenly, fortunes moved faster than anyone could follow, and the old ways weren't enough. I end the counting houses of medieval Italy. Something radical emerged. Merchants discovered that every transaction had two sides. Every movement of money had a mirror. Debit, credit, balance. This was called double-entry bookkeeping. At first glance, it seemed like a small technical trick. But in reality, it was a revolution. For the first time, merchants could see the health of their business clearly. Losses couldn't hide. Debts were tracked. Profits could finally be calculated. And once merchants could see their money clearly, they could control it and grow it like never before. By the 13th century, trade across the Mediterranean was booming. Crusades reopened routes to the east. Spices from India, silk from Byzantium, precious metals from Central Europe, wool from England, and at the center of it all were the merchant republics: Florence, Venice, and Genoa. These cities weren't ruled by kings, they were run by trade. Florence dominated textiles and banking. Venetian ships carried spices and luxury goods. Genoese merchants financed voyages and built the first multinational trade networks in Europe. But success brought complexity. A merchant in Florence might finance a shipment of wool to Bruges, invest in a spice cargo from Alexandria, loan money to a partner in Venice, and manage warehouses in multiple cities, all at the same time. Ships took months to arrive. Partners were hundreds of miles away. Debts piled up, and old lists or diary-style notes couldn't keep track. How could a merchant ever answer the most basic question? Am I actually making money? The answer was almost impossible. Profits could disappear inside dozens of scattered transactions. Loans could be forgotten. Debts could accumulate unnoticed. And in a world where a single shipwreck could ruin a fortune, uncertainty could destroy an enterprise overnight. The growing scale of commerce demanded something new, a system to transform chaos into order. That system began quietly in counting houses, modest rooms near docks, markets, and warehouses, where clerks, apprentices, and merchants bent over desks covered in papers, ledgers, and inkpots. Europeans had just adopted the Hindu-Arabic numeral system, replacing cumbersome Roman numerals. Suddenly, calculations were faster, clearer, and flexible. Merchants could now write down their memory of transactions in a rough notebook called the memorial, organize them in a journal, and finally, record them in a ledger, the libro mastro. Here was the revolutionary idea. Every transaction was recorded twice. Debit, credit. If a merchant purchased goods, one account increased while another decreased. If money was borrowed, cash increased while debt appeared. Every movement had an equal and opposite reflection. The implications were enormous. Merchants could finally answer, "What is my business truly worth?" Errors became visible. Missing money harder to hide. Losses no longer silently accumulated. Trade networks could be managed. Partnerships became stable. Credit became safer. Business shifted from intuition to science. And yet, for decades, this system remained largely invisible. It spread quietly, taught from master to apprentice, until Luca Pacioli, a Franciscan friar and mathematician, wrote it down in 1484 in Venice. His book, Summa de Arithmetica, Geometria, Proportioni et Proportionalita, described the bookkeeping methods of Venetian merchants. Pacioli didn't invent double-entry bookkeeping, but he documented it. Suddenly, the counting house methods became a formal system, teachably, studyable, and replicable. Merchants across Europe adopted it. Universities began teaching it. Within a few generations, double-entry bookkeeping became the universal language of commerce. And with it came a subtle shift in human thought. Every decision became measurable. Every investment had to justify itself. Every debt had to appear somewhere. Business could be tracked, calculated, and scaled. Accounting didn't just record capitalism, it helped create it. The true power of this system became clear when families used it to reshape entire nations. In Florence, one family harnessed this new financial language like no other, the Medici. Founded in 1397 by Giovanni di Bicci de' Medici, the Medici Bank operated across Europe, in Florence, Rome, Venice, Geneva, Bruges, and London. Every branch reported through meticulous ledgers. Every partner, every transaction, every shipment tracked. Without double-entry bookkeeping, such coordination across borders and currencies would have been impossible. Their ledgers recorded everything: assets, liabilities, profits, losses. Risks could be contained. Opportunities could be seized. Decisions were calculated, not guessed. The Medici rose to unmatched power, not through brute force, but through clarity. Later, in Augsburg, Germany, the Fugger family demonstrated the same principle. Jacob Fugger, the rich, built an empire of mines, trade, and loans that stretched across Europe. His firm even financed the election of Charles of Habsburg as Holy Roman Emperor in 1519. Imperial power, it seemed, could be traced and influenced through ledgers. Double-entry bookkeeping wasn't just a way to organize money, it trained the mind. Every asset required a corresponding liability. Every gain appeared as a cost. Business became less about instinct and more about calculation. Risk could be analyzed. Profit could be understood. The ledger became a mirror, reflecting the true state of the enterprise. This mirror allowed commerce to scale beyond the limits of memory and intuition. Partnerships became manageable. Investors could evaluate ventures rationally. Credit networks expanded. Trade multiplied. Capital became abstract. Wealth could now exist as entries on a page, not just physical goods. Fast forward to today, modern corporations, governments, and financial systems still operate on the same principle. Assets, liabilities, debit, credit, balance. The same logic first perfected in the counting houses of Renaissance Italy now underpins the global financial system. But here's the warning history carries. This system only works if the numbers reflect reality. When accounting is distorted, misrepresented, or manipulated, clarity disappears, and crises follow. The 2008 financial crisis was a modern example. Balance sheets looked correct, but they weren't. Transparency vanished, and the system teetered on collapse. 500 years ago, the merchants of Florence understood this instinctively. Their fortunes depended on honest books. Today, the principle is the same: trust the numbers or risk everything. And it all started with one simple invention: the notebook. In the quiet counting houses of Florence and Venice, merchants discovered that recording transactions in a structured, balanced way allowed them to see wealth like never before. Clarity led to control. Control led to expansion. And expansion reshaped the world. Accounting may look like paperwork, but 500 years ago, it taught the world how to think in capital. And once that way of thinking existed, the rest of the financial system was almost inevitable. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.